Should I introduce?
It ain't complicated, you know, man. It's like a damn Rubik's Cube, man. You like talking about that blue, red, man, then you get to one side and like
Hey, Sean, I forgot to tell you about that. We have an intro.
Yeah,
So
we got
anyway.
the intro too. All right. Thanks for putting up with my unprofessionalism.
No worries, man. So welcome to the Jay Burden Show. How are you doing, Sean?
Oh, I'm doing fantastic. Thanks for having me on.
Yeah, so let's start because the chat is eagerly awaiting this. So let's just jump straight into it. So who are you and what do you do?
All right. So my background is I own an independent wealth management firm. So I'm not attached to a broker dealer. It's completely advisory only, which gives me the flexibility to discuss things more than just stocks, bonds, mutual funds, ETFs. And what I really specialize in is exit planning. So when people are selling a business and usually what they invested in the business and what they sell it for, there's a big gap. I help them make sure that when they sell, they don't have to pay the capital gains tax on that sale. And then usually they're looking to replicate the income that they were making from running the business, except in a more passive manner. And I help them with a portfolio allocation that can actually consistently generate that income and not put too much of their principal at risk, which is harder than it sounds, especially compared to kind of how most people see portfolio construction.
So yeah, and I'll give a little bit more of my background than I normally do in this. So I have also worked in wealth management, currently moving from one firm with one business model to the other. It's what I studied in school. I've, any number of, letters and names after my in real life name, not showing them here. Yep. But I will say nothing that I am going to say can be in any way construed as financial advice. I'm a stranger on the internet. Do not listen to what I'm telling you. Now that said,
that goes for me as well, by the way. I do want to be clear. None of this is advice. That has to be something that's one-on-one. We're just kind of talking in abstract about or generalizations of how things work.
Well, definitely. So you and I off camera, we're having a very interesting conversation. And you mentioned that you kind of came here through the libertarian sphere. And specifically kind of libertarian econ pipeline, right? Things about talking about like, the dangers of central banking, the problem with kind of permanent inflation. And that's something that is kind of rote. There's a lot of people talking about that. Right. We'll mention concepts from that sphere, but there are other people who can talk about it. But you and I had a very interesting conversation to start off about the whole concept of a joint stock company. And this is something that Burnham himself mentions, written in the 1920s when this was kind of coming around. So let's start at the kind of like the 60,000 foot level. Maybe let's describe what a joint stock company is, how that's different, and how that's a significant innovation.
Yeah. So especially the idea of it being publicly traded. So the theory is that if you can create this entity, which then is its own type of investment, like let's say an LLC as a corporation. And if you sold off pieces of it or shares to other people, they would be part owners. We're actually talking about Daniel Priest will probably give a much better history of this than I can, especially in this short amount of time. If anybody wants to read his book, Getting Back to Business, it gives the full history of this. He's actually a historian by background. But the idea is you're going to sell off pieces of it. You're going to float it. The company is going to receive from that initial offering the money raised. So it's a way to capitalize a firm. And then in theory, the people who own these other shares are going to be able to participate in the profits. And also in theory, the future value of that stock, if the business does well, should increase in value because the business should be more valuable. This is actually Daniel Priest's point in this, is that made sense when you had a cash flow analysis of that the future value of a stock is just the sum of all the dividends it's going to earn between when you own it and when you buy it and when you sell it. But an interesting turn, because of kind of going back to a lot of that Austrian econ stuff of central banking and managerialism, you look at any tech stock, you look at almost any stock except for blue chips, and even then it's pretty watered down. They hardly pay dividends, or often not at all. And why is it that you have this market where everybody's just relying on capital gains instead of dividend? And in fact, in our industry, a lot of the boilerplate or mainstream education as well. Whether a stock goes up in share price or pays out a dividend is basically substitutable or equivalent. That kind of false substitution is a big part of why long-term capital management collapsed with their Black-Scholes option pricing, because they're not equivalent. But the math makes it seem like it's easy to say that's substitutable. So what I think is very interesting about that, kind of from our neo-reactionary dissident right point of view, is this is how the managerial revolution got bootstrapped. Like you said, Burnham get into this as well, and really kind of my own book is more or less a synthesis of these two. That it's how you get the managers to come in and take over the role of ownership. That basically they're just the stewards. They're part-time stewards. They don't really have any interest in the company other than that they're largely paid in stock as compensation. So they're going to get their golden parachute, but they don't have a real ownership stake in it. And it really becomes much more like managing an administration. So this is why you see publicly traded companies and administrations in government or the administration state all basically work the same way. Really, publicly traded companies are just an organ of the government in the same way. And a lot of that is derived from how publicly traded stock is regulated through the SEC, as well as that share price artificial boost over time is just riding the front of that inflationary bubble. And that's a big part of why you get owners to be disengaged about the stock that they own, is they're sold the story of, well, on a notional or nominal basis, the share price is always going to go up in the long run. Yeah, you have, volatility up and down, but in the long run, the stock market always goes up, or at least only since the past 100 years of when it really got invented at the beginning of the 20th century. Although they'll argue it goes back to, the Dutch in the 1500s, but I think that's spurious. So when, you own this asset, you don't really have to do anything about it. Now you're not invested, and management then gets to use the business instead of caring about profitability. They've basically got that on lock because they can do, especially since the 70s or 80s stock buybacks, that now their income is primarily defined by lines of credit, again, from central banking, which is ultimately run by this managerial elite or government or however you want to think of it. So now any kind of need for being oriented to the real world of doing something useful to generate a profit is completely out the window, right? Price discovery basically doesn't exist. You hear these terms like zombie capital today. And that gives the managerial elite, the managers in these companies specifically, a free hand to internally, they have to defend their position, right? To the board, and they have to have allies. They have to recruit people into the organization. You get a lot of Pornell's iron law of oligarchy that whatever the purpose of an organization is quickly lost because it exists to exist. It's the self-licking ice cream cone. The only reason you're bringing people into the firm is to support you personally in that position of power, as opposed to any kind of competence. And all of this starts to look an awful lot like the nomenclatura under a Soviet regime. It's the same thing. The reason you hire people is as political cronies and not, for merit, or like bio-Leninism gets into this concept as well.
Well, it's interesting because, we've mentioned Burnham off and on, and he very explicitly talked about the birth of this system of corporate managers as kind of the model for the managerial state. And so his point was, okay, look at Ford, right? This is when Henry Ford was still alive.
Yep.
Henry Ford is very clearly in charge of Ford, right?
Mm-hmm.
If he wants something done, it's done. He's like, oh, I like, and there were all number of these, right? He would just make arbitrary decisions,
right?
And his will was done. He was essentially a capitalist king. He would be like, all right, we're using company profits to talk about my favorite minority groups today. And it was like, oh, well, he's the boss. I guess we have to do it. Whereas now it's like, well, who's in charge of Ford? And it's actually a very difficult question to answer. And so you have that structure, right? Which is the structure of kind of how corporations are run. But on the back end, right, once you start to understand these systems, you realize that that's not just true in the sense that, the products you buy are produced by these managerial systems, but essentially your money is taken without really your consent and put into large managerial systems where people will use your money to control other companies. And it's this sort of like, once I remember I had this moment. So one of my econ teachers, I've mentioned him before, was this unironic Klaus Schwab fan. He was this German guy, and he would actually get videos from Larry Fick and Klaus Schwab and just sit in class giddy. And he's like, isn't this great, guys? And I'm sitting in the back of class. I'm like, oh no, maybe we're the baddies. But in that, right, you learn about the power of wealth management. Not wealth management, that's the correct term, but the power of these massive ETF companies, right? Places like BlackRock, very infamously, Vanguard does this as well. And because of the kind of like devolution of retirement, right? So libertarians will go on and on about like, oh, you know, when Social Security was invented, you know, it was a very small elderly population, you know, very few people ever drew from it. Now that's true. A large part of that is that pensions, traditional pensions, were much more common, right? Those are vanishingly rare now. You know, some firms have them. Mostly they're older established firms. But what many companies, almost all above a certain size, offer is the venerable 401k, right? Which is a place for, you know, you and your employees to combine your money. There's a whole, but I'm skipping over a lot of details, but I assume people do
There's
not
a
care.
good book on that too. Let me see if I can actually pull it up real quick. Yeah, the 401k was basically invented by the mutual fund industry in order to sell mutual funds. Mutual funds were very rare. There's kind of this historic competition between mutual funds, bank trusts, and I forget what the third is. Maybe just traditional stocks and bonds. But the fact that everybody thinks in terms of mutual funds now, and then ETFs are kind of the successor to that, really was as political patronage of creating the 401k. And as I get into it, okay, go ahead. Yeah, I'll rant.
No, sorry, I just want to finish this thought.
Yeah.
The reason that's important is because essentially, because of the inflationary nature of money, you need to invest, right? If you don't invest, you are getting screwed over. Well, and so, okay, how do you invest? Well, I mean, up until very recently, putting your money in the bank was effectively economic suicide, right? It is only marginally better than sticking it under the mattress. And even then, really only barely. And so what you're incentivized to do is give your money to these mutual fund companies. And what they will do is they'll break your money into 1 million different pieces, invest it into 1,000 different companies, and you'll be given an average rate of return on the other end, essentially. But Vanguard, because they have so many people's money, has a ton of power. And what they get to do is they get to use your shares as voting shares.
So I actually dispute this point a little bit. Finish it, but yeah, I think this is kind of like a bit of a boomer truth concern, because I don't think actually having the voting stock matters. It's the managers in power that are still going to do whatever they're going to do. But
well, I would make the argument that because of how many stocks there are, control is so dispersed that effectively only the top 3 shareholders really matter. And those are normally one of 4 to 5 companies. And at that point, you're right, those managers, the people in charge of that holding matter, but their control is immensely outsized from how much they personally own. They as a person, not as a corporate entity. Now, admittedly, there is a WEF tard, you know, like Larry Fink is going to steal your lunch money kind of take, which I don't endorse.
Yeah, or even just the boomer idea of, I think under this managerial system that we've had for over a century, there's an exaggerated sense of the significance of ownership inside of a managerial regime. Yarvin has that point of, you kind of have to think of yourself as being in the Soviet Union, and things make a lot more sense. And I think if we had that communist optic of the difference between private property and personal property, the managerial regime is set up in the same way. Or Lenin called it the commanding heights, if you're going to talk about kind of this iron law of oligarchy phenomenon. All the important, or it's a George Carlin bit, right? All the important property, all the important business, anything that is actually going to make any real difference is all controlled by a very specific group of people. Occasionally you get an Elon Musk who throws a wrench in the works, but in general, it's the same team who own anything that could actually be impactful. And then they allow the leftovers that can't really do anything to be owned by everybody else. They could say, well, you own this too, who are you to complain? But it's because they feel safe in knowing that's not going to make a difference.
Well, and I got into
voting, right?
Yeah, exactly, right. I got into let me say first, here at the Jay Burden Show, we believe in every election, all of them.
Right. Yes.
There's never been a fake one. But so in all of this, right, there's an interesting discussion to be had about essentially what is money. Because if you look at kind of the nature of currency. And I'm not a gold bug, right? Fiat currency is a tool, you know. Now, admittedly, it's been used by bad people, but all the same, it's a tool. But the problem is, right, effectively participating in this system is no longer optional, right? Your two options are lose or play the game, right? And you mentioned, right, that the previous version of saving looked very different, right? That saving and investing were not synonymous. So do you want to talk about that a little bit, just as kind of a framing device?
Yeah. So a few things there. Before I forget, the one, not just that your 401k money has to be invested or you know, you get this tax incentive for it. You know, this is how you have to save for retirement or how to stay ahead of inflation. Again, that's well-worn territory. The other part of that people really need to consider is the whole reason that was created was to absorb the inflation from the money that was being printed at the time, right? So it's a way to, this is kind of like a very MMT idea. They've you know, increased wages and people are earning more and there's all this money out there, but you don't want them to consume it, because if they consume it, you're going to see a rise in consumption prices, right? So how do you control that? Oh, you get them to buy this dead capital. They're now going to defer part of their paycheck it back into the system where on paper, these, you know, the, what's the word I want to use? Accounting fiction is going, you know, on paper, it's going up in value. But really that's all like, you're basically just throwing your money in the toilet. And yeah, maybe in theory you have a claim if you have functioning markets and you can sell at the right time, but it's just a way to absorb it. And then what was your other question? Because I do want to get back to the like, what is money question, which I think is
well I wanted to talk
profound.
about, because what is money, and it was connected to the fact that now saving and investing are effectively synonymous, and that did not used to be true. And actually, it's almost like those two ideas are kind of connected. So you want to start with money because it is related to that, right?
So yeah, this is a kind of an eternal question. It makes everybody feel like they're like a bullshit artist philosopher of, you know, well, what is money? Especially kind of the debate of commodity money versus fiat currency. And again, a lot of that well-tread stuff. The fact that Yarvin came up with, well, actually, you know, in a fiat regime, money isn't really, there's also this theory for a while that fiat currency is a zero coupon perpetual bond. So there's some, you know, there's something called near money. So if you have like a CD or a treasury bill, it's near money. It's liquid enough that it'll be accepted. And historically, a lot of these bonds, like in the 1900s, were accepted as money, even though they also paid a coupon. And basically the idea is, well, once a Federal Reserve System came in, they just got rid of the coupon. But the idea of trading in these bonds is the origin of that. I think that kind of misses a trick too. That might have been kind of the mechanism of how it emerged. But realistically, I think it's a lot more helpful to think of it as a stock, which is, again, Yarvin's whole idea from, was it General Introduction or the other one? But also one of my financial heroes, Mike Green, who is one of the biggest critics of indexing, that there's no such thing as passive. Really what you're doing is algorithmic investing of every time you get money, buy, and every time you need money, sell. It takes the shock absorbers out of the system, that if there ever was a major sell-off systemically or a market crash, you will not necessarily get markets that clear, which is a big disaster if everybody's retirement money is tied up in this system. They're kind of taking it on faith that markets will clear. And if you need to, you know, sell that stock in order to generate retirement income, that you're actually going to be able to, you know, the bid-ask spread is going to be able to meet in the middle. But he also had this idea of, yeah, under a fiat regime, really what you're owning when you own Federal Reserve notes is shares in that government enterprise. And if people, I think that's an interesting avenue that hasn't been fully explored or flushed out, but it's an idea that I think has legs and deserves some more thought in that direction.
Yeah, I don't know. It is an interesting, I know it is.
I think it makes more sense
yeah.
than commodity money or bonds. Like those are kind of your choices, right? Is money a commodity? Is money this couponless bond that never renews? Or is it a stock? And it seems to behave a lot more like a stock, especially the fact that they can issue more of it. They can buy it back. The way the market is made is much more like a stock than it is any of the other options in practice.
Well, and that's sort of something too, right? Where it's like the way you're taught about money in school, if you are, and I realize that many people have no formal training whatsoever, which you're kind of put at a disadvantage, but it's sort of deliberately obfuscated, right? You know, like all of
I think even the experts don't. I mean, I don't know what money is. This is, I think, an open question. Like we see how it's constructed and how it gets used, but if you really push people, you know, like, what is matter? Oh, matter's made of atoms. Well, what are atoms made of? Like, there's kind of this point where you hit this wall of like, what are we talking about? Like, what is it really? And you'll hit even where any expert, and of course, most experts are bullshit, but you'll hit a point where even the experts are like, yeah, I don't really know either. So it's an interesting, you know, it's like a mass delusion that we all go along with without critically examining.
Not really asking like what we're doing.
Yeah.
Well, and I mean, that is, there are sort of multiple sectors of the economy that are essentially one giant confidence game. Like one of the ones I've just kind of continually looking at ever since I found out about it is this is a digression. We'll get back to the topic at hand.
Yeah.
But is subprime auto loans. Like once you learn a little bit about how auto loans are used, you know, like what kind of instruments they're bundled into, and then you kind of do the math and you're like, how many sketchy car lots have I driven by with the phrase "will finance anything"? I'm like, wait a minute, these are connected. And then you actually look at the data on that, and it's something like, I think it's like 30% of loans are in some way delinquent, and you're like, I don't know, man, this doesn't seem good. And effectively, it's just kind of one of those like, well, if we don't look under the rug, it will never be a problem.
Right. Which I think is the natural consequence of a bond-based economy, which I think is kind of why we need to look at as sovereign bonds as the origin of that. The whole Eurodollar system is very interesting, and correspondence banking abroad. You know, I mentioned Mike Green earlier, and his theory basically is that the Big Short, commonly understood reason for the 2007-2008 great financial crisis is bullshit. That's the political cover story in order to get the bailouts, is to say, oh, well, we gave all these people subprime loans, and you know, and it was Bill Clinton and I think both Bushes continued this policy for decades of trying to give people who have proven time and time again that they don't repay their loans to get houses, because of this idea of like an ownership society. Well, if you make them have an investment and they don't just live in government housing their whole life, you know, maybe they'll start learning some responsibility, and it doesn't really work out that way. But that really had nothing to do with it. It's in his view, as I understand it, and Mike Green has this habit of, as he's researching things, he'll kind of drop hints about stuff that is interesting to him, but until he has a fully formed thesis, he doesn't really get too into detail. So I don't want to misquote him if he's watching this. That'd be, thank you for watching this. I'm honored. But his view, as I understand it, is really what happened is Hurricane Katrina knocked out the oil refining capacity in Louisiana. That really upset kind of the cash flow balance, sort of that scene in Network with Ned Bailey. You know, they have taken money out of the system and now they must put it back. And without that, the lack of foreign dollars is really what precipitated the liquidity crisis. And that, because actually, and his argument for this, what kind of tipped off his research into this, which I thought was the most fascinating part, is more money went to bailing out foreign banks than domestic ones. Now, if you're a politician, that's a hell of a pitch, right? It's almost as bad as having Border Patrol help illegal immigrants into the country. But, you know, imagine going in front of the public and, yeah, you know, we got to create TARP and bail out billions of dollars of foreign banks. I would like to think most people would say, well, F them. Like, why do I care about foreign banks? They're on their own. We could take care of American banks and Americans. But the idea of bailing out foreign banks seems ridiculous. And even then, there's a big argument of, well, no bailouts for anybody, because we thought we had this capitalist system that's always been BS. So the only way they could really justify getting the mechanisms in place that they needed to facilitate that, and these, what do they call, like cross-purchase agreements or whatever, between different banks in different countries, was to say, okay, we've got to create this TARP money and we're bailing out the American homeowner, right? So that was the story that got constructed in hindsight. When
right, it was sort of the wrapping paper around the brick, basically.
Yeah, and it makes everybody like, it's the shit sandwich. They're able to stomach it. You put the bread. Oh, well, yeah, this is terrible. And it's going to create all this inflation. And, I hate that these, people who knew they were doing wrong are getting bailed out. But, don't you feel bad for all those people who got evicted from their homes? We should do something to stabilize that market. Oh, all the boomers, their retirement money is at risk. We can't let the whole system collapse, blah, blah, blah. So it was just enough to kind of like get done what they needed done. But really, the interesting part of that argument is it had nothing to do with housing or subprime. It had to do with the Eurodollar system, where the Federal Reserve controls the creation of money and credit inside the United States. But outside the United States, it's a free-for-all. And basically, banks make up their own rules of, oh, yeah, I've got this amount of dollars in my account. And speaking of kind of it being a pyramid scheme, hopefully they have enough in their vault or whatever to come up with when there's an obligation that needs to be met. But as far as what's actually in their reserves, it's fractional reserve all the way down. So there is a sense of like, and gold has this too, right? If you're familiar with the gold market, that what is it, like 100 times as much gold notes than there is actual supply of gold, and silver is like 1,000 to 1 or something. Like there's just way more claims on it than there is the actual underpinning asset. So, but as long as nobody ever tries to make a claim, big enough to corner the market, the system keeps perpetuating. And that's basically how the Eurodollar system works. And that gets into, coming back to kind of the professional side of what I do and maybe used to do. That has a lot more say than like just kind of the very naive Austrian take of like, interest rates and supply and demand of money. The Eurodollar system throws all that out of whack.
Well, and it's interesting you bring that up because whichever in the last round of banking failures, right? It was a couple of big Euro banks who got hit with it. And I was a kid when the financial crisis happened. And so I was going back through and reading, and I was like, oh, these are zombie institutions. And they were zombie institutions effectively since they got large bailouts in 2008. And so actually you've just kind of completed the back part of that circle. And that actually explains a lot. Okay. So fair enough. Look, I learned something too on this show, right?
Oh, good. I'm glad I'm good for something.
That's a joke. You're well above my pay grade. So one of the things that I want to get onto is, and we've kind of, we keep having digressions, but it's an interesting point, right? That the nature of kind of saving and the idea of retirement is kind of an artificial one. You brought up this idea that, the idea of having a 401k was essentially like industry pork. It's a way to
and it worked for the government to absorb the inflation that was no longer, once Nixon closed the gold window and any even pretense of a gold standard went out the window, the way to absorb that was through 401ks and IRAs. That's why ERISA got passed a year later. There's an interesting parallel to this too that I met through. So I mentioned Daniel Priest before, and his background before he got into finance was actually as a Russian history scholar. And the Soviet Union did the same thing. After World War II, they had an immense inflationary problem. It was kind of like, what the Confederacy had. They inflated directly, whereas the North sold bonds to Europe. And that's a big part of why the Union won and the Confederacy lost, is how they financed the debt and kind of the accounting fiction used. And they, as a more authoritarian system. So they required all the factory workers to buy these ruble bonds that were like CDs, right? What's the term for that? Time block notes or whatever. Time deposits. And then to
explain that to people who are not in industry. Essentially what that means is, you make 5% on this investment, but you have to deposit your money and you're not allowed to have it back till the end of the time runs out.
Right. You're trading liquidity for a higher yield or interest rate is the idea. And liquidity is kind of, again, the third people, there's price risk. What's the other one? But like liquidity is always kind of like the third one that everybody forgets. So this idea was, you could put your bank in the savings where it's available immediately. Or if you lock it up for, let's say, 10 years, you're going to get a much higher interest rate. And there was like no opportunities to invest in the Soviet Union because it's a communist system. And, so it was one of the few avenues that people had. Plus, they were forced to do it. But the only reason they were really doing it is because they needed to suck the money out of the pay that they were paying workers so that the price of consumption goods wasn't going up. and they could take control of inflation. Now, it just so happened that when all those time deposits came due and they were supposed to get paid out, they revalued the ruble and basically wiped out the savings. So like as soon as anybody could theoretically reap any kind of benefit from that, happens to be when they changed the rules. I would argue there's something very similar happening with IRAs and 401ks now that we've reached that tipping point that boomers, who are the first generation to go through this social experiment, invented in 1974, 1975, that's when they were in their 20s. They get into their working years. IRAs and 401ks really start to take off in the early 80s. And they've been told to participate in this ever since. And now instead of depositing the money, they're withdrawing. And then again, hat tip to Mike Green. The other half of that is not only that, but they've been convinced, oh, you can't beat the market. Just put it in an index, low fee index fund ETF. Don't think about it. And it's just this automatic buying of basically market cap, like whatever are the biggest stocks are the ones that you're going to be buying. Whoever is in the Fortune 500 is going to get the boost of being in the Fortune 500 if you're buying the S&P 500 index. But once they go from buying to selling, that they're taking withdrawals, and they're all, because they've all been conformed to these same indices, they're basically all selling in lockstep the same assets at the same time. So they need to sell in order to generate their retirement income. And they're selling the same, which that in of itself as a demographic thing, because boomers are still, I believe, the biggest demographic or cohort out there. That alone can cause price depression, right? They all sell at the same time, which is, the supply is going to increase and the demand won't, so price will go down. On top of that, because of the great financial crisis, younger generations are much more speculative of securities in general. They really just, some of them went into managerial positions themselves and they got 401ks and they follow their parents' advice, but they're much more skeptical and in general don't participate. So, it is a market, right? You have to connect buyers and sellers, and who's on the other side of that trade to buy what the boomers are selling. On top of that, the boomers were able to ride that wave up of, on paper, their assets increased in value as the inflation went up. But the younger generations were told to buy in at the highs, which is another reason they were discouraged from actually doing so. Is it, they felt like, I can't get in on the ground floor the way my parents did. So what is their incentive to buy in, as it's a falling knife that the boomers are trying to sell, and if they can't make that market? And a lot of those regulations that went through between that and the 2019 interest rate crisis, where the overnight interest rate was highly volatile, which was maybe had something to do with the lockdowns that followed the next year. Where is it going with that? I think that there's now the facility that, you're talking about, again, the managerial elites and kind of this cohort of Vanguard, BlackRock, the ones who are running the indices. The maiden lane structure for mortgage-backed securities, and actually during the special purpose, I know I'm getting maybe a little all over the map here. Bear with me.
No.
The special purpose vehicles that were set up also during the lockdowns from, late 2019 or early 2020 until 2022, let's say. The theory is the Treasury was, or the Fed was, illegally buying a lot of corporate bonds, but because they're doing it through a government established special purpose vehicle, that's like the loophole. It's the same loophole that Maiden Lane used for mortgage-backed securities. Basically, even though it's formally illegal, like John Hassness, right? The myth of rule of law. If it's a choice between survival and sticking to the rule of law, they're going to choose that the constitutional rule of law is not a straitjacket or not a suicide pact every time, or a self-deletion pact, I should say. So the mechanism is there for the government to take over that index fund function if, the private industry or whatever is not able to handle that. If the boomers need to be able to sell to generate retirement income, and they can't because the market makers cannot close that bid-ask spread, which in the early days of 2020, there was like a week where I believe it was, look this up, don't just trust my word on this, but I believe it was AGG, which is one of the biggest intermediate bond I think it's intermediate bond ETFs, was so volatile that it went untraded for like a week. And that's considered a very deep market. That's not it's not like a penny stocks, right? Like that's a major security but what the sellers were willing to sell for and what the buyers were willing to buy for, they just could not, the market makers could not close that gap. That kind of volatility where markets don't clear, I think, is actually the real hidden form of risk, in the same way that nobody, who doesn't pay their mortgage was kind of the theory, right, with the 2008 great financial crisis, until you find out that, yeah, people will walk away from a mortgage. I think we're seeing something similar with this social experiment of the 401k and IRA, that as boomers need the money and they go to sell and there's more sellers and buyers and they can't get their money out like they were promised, there will be a tipping point where the government says, okay, well, we're going to guarantee this monster that we've created. And like the time deposits, I think they're going to put some kind of gate or cap on the liquidity, where they'll say something along the lines of maybe, we'll treat this like an annuity where you can only take out up to 10% a year, and we're going to guarantee at least a 5% withdrawal rate so that you have this money to retire on, which is really what this whole system was for. But the idea of a fully liquid market where you can say, you know what, sell everything, I'm going to go long on gold and Bitcoin or something like that. Again, not financial advice. That'll be foreclosed. They'll put a limit on what you can actually do with your own money, and they'll do it under the guise of regulations for the Department of Labor and ERISA, as well as the SEC, to do that. I think yeah, go ahead.
Well, and what's especially interesting, you bring up that idea of, well, it's in the Fortune 500, so lots of people will buy it because of that. Is that I'm sure you've got these type of questions where you're at a family dinner and they're like, should I buy XYZ stock? And it's normally something people have heard of, and it's kind of a flashy name, right? And one of the kind of quiet stories of the last 30 years is the rise of tech stocks, right? And that kind of marketable brand of tech stocks. And so it's this whole kind of, the Silicon Valley industry, which is based on extreme exponential growth, right? The idea that, this company it'll be the next Google, right? We'll go from, we'll have, multi-1,000% returns, right? These kind of absurd things. And the problem is, it's kind of, that's a line, that's a lie, that's a narrative sold to so many people that you sort of have there's too much interest in these companies, that if it were just every stock ticker was randomized, it's just pure analysis, right? You're looking at the fundamentals. None of these companies would have anywhere near the stock price they command. And it was especially interesting to watch that. And you mentioned that, young people are kind of skittish around securities. I found that to be largely true. But the Robinhood phenomenon, right? Where essentially everyone's sitting at home and they're like, well, whatever, the world might be ending, so might as well dump some money into essentially like a stay-at-home slot machine.
Right. And they don't know that their order book on Robinhood is being sold to Citadel to buy the opposite side of the dumb money. That the reason you get a free share of stock from Robinhood and all this fintech crap is because the real players are like, oh yeah, give us that information. They're the house in the casino. We'll take the other side of that bet and they will win. And even when you have the diamond hands phenomenon, if somebody's going to break the tie, they've got the political pull to make sure that it breaks in their direction.
Well, and in that, the reason I brought that up is it's very interesting what stocks people bought, because they're essentially what stocks someone who uses Reddit has heard of. So things like Nvidia, things like Microsoft, and all of these, right? It's kind of a broader trend, which, like you've said, these companies are not run to produce a dividend. They're not run to produce profits in the traditional sense. Admittedly, tax law has changed, so it's less beneficial to produce a profit than it once was. But at the same time, right, you see this kind of like systemic move to.
Yeah, I think the jargon term that gets thrown around is fiscal nihilism. The stock market is a casino. It's all just gambling. Fundamentals don't matter. We're all just doing like trend analysis, right? We're just chasing, to grab the tail of the whale or to, follow things up and then bail before everybody else. I think the destruction of price discovery and fundamentals is exactly what happens, especially since the 2008 crash, because that wiped out the bond vigilantes. I mean, there was a time where monetary policy could legitimately be challenged by private actors. Now we're sort of seeing a return of that because interest rates went up so much so fast that you have private equity basically playing that role of the bond vigilantes, which I think is fascinating. This starts to dovetail into my interest of like private equity versus publicly traded. And I think the dissident right position is we need to look at privately owned companies a lot more. I think that's kind of where the lifeboat is going to be. You know, I think there's always going to be a need to invest in capital structure that is profitable in order to make the future better than the past. I mean, I think that's kind of inescapable. I don't think, you know, society will not work very well if everybody is Uncle Ted trying to live on their own with subsistence farming. But how do you bail on this system that has been captured as cronyism to just give jobs to political allies as opposed to any kind of care or concern with growth, which I think, you know, whether we call it the great stagnation or, you know, the Nick Land, Mark Fisher types call it the slow cancellation of the future. We're just doing what the Brezhnev stagnation was in the Soviet Union. There was a point where they said, we can't fix this corrupt system. We won't do Gorbachev's reforms. This is as good as it gets. We're just going to stick with this. And that lasted, you know, for what, 15, 20 years until, and especially among Stalin's circle, right? So Stalin dies. I think probably, hopefully most of this audience has seen Death of Stalin. But all the people who were then premier after him were in that circle. It was not until Gorbachev, who was a child when Stalin ruled, that was really the first outside that circle to try to take over this dysfunctional system. And he could only oversee its collapse. Like by the time it got to somebody outside of that circle, it was already basically a foregone conclusion. And I think as we watch Biden, who doesn't know what room he's in and is shaking hands with invisible people, Dianne Feinstein literally dying in office, Mitch McConnell having mini strokes on live TV. I mean, we're witnessing that with our version of that political class, where basically they're all going to, you know, expire in office and nothing can get reformed, you know, until the day of the pillow or something, right? Is, you know, until that generation passes into obscurity, you know, the system will never get reformed. And because it won't get reformed, or there, you know, it would at some level there will probably, I'm not trying to be some doomer, but there probably will be something like a collapse, let's say. And I think we need to think about like, okay, much like we think about, well, what are the alternative organizational structures to, you know, the managerial progressive system that we have? How do we create a parallel system that works? I think we need to be looking at that private equity, which is apparently in a position to be so cash rich, even in the government's own system, to influence monetary policy and modify interest rates, as well as they don't have all the encumbrances or the political favoritism of publicly traded stock, right? If you're listed on the NASDAQ, you have to have at least one woman on your board. You know, they've got their DEI agenda baked into that. Privately owned ignores all of that, and so far is kind of flying under the radar.
Well, there's sort of an interesting layer to this as well. So, you know, you've mentioned that you're independent. I am moving from one soulless Globo Homo Corp to another, right? Hopefully a marginally better Globo Homo Corp, but nonetheless. Yep. But it's interesting in that, right, that, you know, one of the kind of core features of managerialism is the rule of best practice, right? That you've mentioned the function of joint stock more generally, which is to essentially obfuscate control, right? To make it very difficult for one person to essentially say, like, this is my line in the sand, we're going to do this. And what's interesting is that the kind of dual rise of best practices, that kind of passive investing strategy. And for those who are not in the know, the traditional distinction between passive and active is passive is basically betting on trends, right? In general, the market goes up, so I don't really bother buying specific stocks. I just buy. And that's kind of best practice, you know? And when I mean that as kind of a term of art, as that's what, if you get a finance degree, as someone who recently did, that's what they'll tell you.
Yeah. Experts say.
Exactly. Experts say. And the reason that everyone does that is essentially because experts say it. Well, I mean, you can't be held responsible if it's wrong.
Right. And so it's professional risk as well. No, you know, if what's that Machiavelli quote of, you know, it's very hard to bring about a new order because the existing order works well for the people who it currently works well for. And you're not proven that the new system is any better. So your friends are very tepid and your enemies are very secure.
Well, right. And so in all of that, right, you sort of have this institutional momentum, and it's very, very difficult unless you sort of own your own thing, right, to get
Mhm.
your money out of that system. So
Right.
one of the other things, right, that's kind of hot in the news is AI, right? And the rise of the robo investor has kind of been predicted for quite a while.
I've been
But one
hearing
of
about
the
that my whole career.
yeah,
Yeah.
yeah, right. We're one day away from losing our jobs. But in that, you see this interesting dynamic where effectively, because of a combination of laws, how well they are applied is up for debate, on
Mhm.
insider trading, and effectively everyone having a supercomputer, that we've just got to this point of informational parity where essentially we know so much information doesn't matter anymore, right? Where it's
Mhm.
almost like everyone knows everything that you're allowed to talk about.
So I actually am going to push back on that a little bit because it's. I'm glad you brought it up this way too, because I experience this a lot, being on the young end of Gen X. But this seems to be the millennial viewpoint that has emerged or been inherited, and it's especially rife in fintech. Like that's a great example. But I encounter this a lot when I'm doing my presentations or education for people, and but it tends to be millennials on the younger side, and then the boomers on the older side, and what they kind of will agree on in some way or another is, well, how are you presenting the idea that you're pitching an innovation? If this was truly innovative, it'd be on the internet. Everybody would already be doing it, and you wouldn't have to be educating me on it. So so part of that slow cancellation of the future phenomenon that I think is or the stagnation that I think is very fascinating is this idea of like, everything that has been or that can be invented has been invented. There's disbelief in the idea of improvement or innovation or that the future can be better. And instead, and millennials who've been denied access to capital, again, boomers have a death grip on it and it's remained at a relatively high price. It's priced them out from really participating. So they've really leaned into kind of social media and influencer culture as like an untapped resource to try to give them something that they can own that wasn't already taken. It's the same reason why cryptocurrency is kind of in that boat as well. But then part of that is that like marketing runs everything. I see in almost every industry that everyone is solely worried about marketing. People talk about themselves as their personal brand. And the idea of like, okay, but what are you actually doing that's better than other people? And they look at you like you have two heads. And they're like, well, what do you mean? You can't actually do anything better. You're just marketing yourself better. I think that's a cultural problem that is severely unaddressed and really dangerous. The idea that like nothing new can exist. And it's frustrating for me because there's plenty of a lot of my firm is hinged on, well, no, there's a lot of strategies out there that just aren't used or that people don't know about. Michael Milken creating the junk bond market based off of reading papers from an analyst who was at the Chicago Fed, if memory serves. But that idea of like creating a new market or creating an innovation, even though AI itself is an innovation, I realize I'm kind of talking against myself here, but the pervasive psychology is that there is nothing. And then, yeah, as far as going from one broker dealer to another or covering your ass and working in the industries, well, everybody's going to use modern portfolio theory. That's the only way that anything is done. Of course, it's already a solved game like Connect 4. So all anybody can do is implement it, which means the only strategic advantage you have over anybody else is like relationships and marketing and kind of all these soft intangibles, right? These soft skills. And I think that's kind of ridiculous. Like that's like saying we can't make a better car, so we're just going to try to improve what colors they come in. And that's a dead end, right? Like there are other asset classes, there are other ways of constructing portfolios that both reduce risk, which means that you're increasing your compound annual growth rate. It's just a matter of knowing about them. How do you get access to them? A lot of them are very difficult to get into. Mark Spitznagel and the whole idea of like long volatility until recently was notoriously difficult to get into. Kind of like, what's his name? When he had to, create the covers against some mortgage-backed securities, right? That the credit default swaps. You basically had to like invent those in order to bet against the housing market, right? There are financial innovations which can take place. But we live in this world where, yeah, people have become inured into this mentality of, well, if there was any innovation because of the internet and social media, yeah, everybody would be doing it already. So then they have this innate skepticism of like, well, this can't be as good as you say it is, because if it was, everybody'd be doing it already, which is a weird circular logic.
Well, and that's what's kind of interesting, taken, with that kind of analogy you made to kind of the late Soviets, right? This kind of like ossified regime,
Right.
where
Yep.
everything is kind of already done. And so when you take that on the secondary level, where the fact that like it's kind of difficult to say, and this is going to sound stupid, but let me back this up when I say it, that it's kind of difficult to say why the market is going up at a pretty fundamental level, right? Where if you look at kind of like, okay, like, are we producing more? Which like when the way that you're describing, GDP, right? Like, okay, this should be a rough measure of things done, right? And you have all these kind of like exogenous sources of capital rushing into the system, right? You have quantitative easing. You have people kind of riding this ride of, well, I put in my 6% plus my employer's 6%. There's kind of an artificial demand for the Fortune 500.
That's why it's a closed loop. I mean, the MMT people are not far off. I think MMT and Mike Green's more on this than I am, because Mike Green subscribes all the way to the point where he says that you need taxation to kill inflation, which I think is kind of nuts. But the MMT idea in general, basically it's a closed loop of you're producing inflation on one side, and then if you don't want it to spiral out of control like Weimar Germany, you've got to absorb it somewhere else. For most of the neoliberal era, that was absorbing it in IRAs and 401k plans of the biggest working demographic in America. Now they're selling that off, so that's no longer, they're at carrying capacity. We're also seeing a lot of warnings now about carrying capacity of sovereign bonds. The market makers, who by law have to create a market in them, are having a very difficult time convincing people to buy them. Other institutional players. And the only reason it's going up is because of that inflationary force. Because there's that's the first thing that absorbs that asset bubble. What's his name? The Princes of Yen guy, Richard Werner. He figured this out for Japan, and Japan's the canary in the coal mine, right? Japan is basically always 20 years in the future of the West. They're the tip of the spear. And, when they had their crash in 91, 92, that was that same phenomenon, that when you create credit, it can go into one of three places. Either it goes into consumption, which means that you see the inflation, the price inflation that everybody's familiar with. When you have helicopter money, suddenly the price of gas and consumer goods and, meat in the store and everything goes up by 30%, which is what we saw when that's what happened because of the lockdowns and people weren't allowed to earn an income by working. The second is you get an asset bubble, which everybody in the investment space loves, that prices go up just because more dollars are being pumped into it. And that's what you see with securities. That's what you see with real estate. And you don't actually have to do anything other than have access to a line of credit to be able to dump it into that before everybody else. So that the Cantillon effect, right? And then the third that has been crowded out by this phenomenon is capital expansion, CapEx. The idea of, well, you should invest it in a business that then buys a factory that can get economy of scale to make things for a lower cost, and that's more profitable and creates real value for real people. I think that's a big driver of the great stagnation as well. And certainly there's domains, it's incredible that TSMC can make chips that are at 3 nanometers or whatever it is now. But aside from some very specific industries, innovation's basically been crowded out. Peter Thiel kind of has this point too, of like, because of overregulation and credentialism, there's no free room to innovate. Actually, this does bring it back to a point you mentioned earlier that I do want to expand on, is when you have an owner king like Henry Ford, or even, I would argue, Steve Jobs or Elon Musk, these people who are like big personalities. The head of Sony, when the Walkman got created, and the Walkman was like this big deal, it's because he was flying on jets to go to different meetings, and he wanted a portable way to play his opera music. And he happened to be running this giant electronics firm. So he just commanded his people, hey, I want a small tape player that I can take with me when I travel for business. They tried it out. They had a similar product that they were selling to reporters at the time to record interviews, and they stripped out most of the recording part and miniaturized it and reused a lot of the parts. And that was the first Walkman. And then it turns out that this is something that everybody wanted that they didn't realize. But it would never have formed by like committee or market research. It's because the owner of the company wanted something for himself, and it just so happens that the thing he wants, other people wants too. Steve Jobs has that with the personal computer, which is then where you get the Macintosh, and then he repeated that with the iPod. And then the iPhone, well, we should just have a touchscreen. Everybody else thought touchscreens were a ridiculous idea. And he's like, no, we're going to do a touchscreen. And now that's every phone looks like that candy bar touchscreen, right? You need that independent head, that like the father of the firm, to make those kinds of command decisions based on real need, and not just everybody trying to protect their job, keep their income, increase their stock share, all those managerial things, because they're not in it for the long run. If you're actually an owner, and especially if it's family ownership, your time horizon is very long, right? You have a very short or very low time preference. Whereas if you're management, if you're a nomenclatura and you're just selling out your position to enrich yourself, well, I'm only going to be here 10 years anyway, and then I'm going to retire. So what do I care if the company collapses or is dysfunctional? I'm going to bail before I reap the consequences of my bad decisions. And I need to, kind of coming back to the covering your ass thing. Yeah, there is a principal agent problem of, this is difficult for me, that actually, this is why you see closet indexing so much. So even funds that are in theory active management, they will hug the index, because in periods where, maybe they make an investment that it would be a great investment, but it'll lose money for 3 years, and then they'll see 20-time returns. But that period where you lose money for 3 years in a row, they'll be fired before they can ever see that through, because of, that it's a managerial system where they're not the absolute ruler of, willing to have the nerve to see it through to completion. In any of these administrative projects, you will never get anything of substance done because nobody is around long enough to see it through. And selectorate theory, if you try to do that, the guy who wants your job and wants to replace you will be undermining you the entire time. And it's easy to point at you and say, 3 years of losing money in a row, it's time we kick this guy out and put me in charge instead. The only way you can get around that is by having that absolute authority and absolute ownership. And it's rare because of the managerial system we have.
Well, and that's why I brought up that idea that essentially everything has already been done, right? Because you have that layer of everything that
so on
you
the
can
other side,
defend to your boss has been done. Where it's like that idea that like within that paradigm of like, if I play for anything other than the game as narrowly defined, I'll lose my job.
Right.
It's sort of like, and not to get overly postmodern about it, where it's like, if everyone believes it's true, it sort of functionally becomes true.
Right. Yeah. It's almost like it's inevitable. The expectation becomes inevitability. Right. And then this is then dovetailed with Tyler Cohen's idea of like all the low hanging fruit has been picked. Right. So anything that'd be kind of like an easy one up, like John DeLorean creating the GTO, where he's like, oh, let's just take this car we already make, shrink it down, put a big engine in it, and I'll finagle the management. It's not really a racing car, but it is a racing car. And he, is able to confuse them long enough to get the sales out. And then it's this smash hit. And suddenly he's like one of the youngest executives in the auto industry, right? And which is why he goes off to found DeLorean Motor Company. But without kind of those easy things of like, oh, we already have these things on the shelf and we just have to put them together and I can get it to market fast enough that before anybody really comes after my ass, it'll be a success. And then once it's a success, success has many fathers, but failure is an orphan. Like that's the get out of jail free card for everything. If what you do works and makes everybody a ton of money, then all is forgiven. But until then, your neck is on the line. So if now we're at the point that all of the easy things to do have been done, that's I think also you're right. Why you don't see nobody has the nerve to make the deep investments that are necessary to do more genuine innovation.
So Sean, somehow we're out of time. I really enjoyed this episode and I really got away from me. So we do have one super chat, Michael Pohl, good friend of mine. This has been an 11 out of 10 episode. Looking forward to a whole season. Well, I also enjoyed it. So Sean, and like I said, we'll have to have you back on because there were probably a third of the things that I wanted to talk about, but I always enjoy episodes like that. But if people want to find, more of you, more of your work, what's a good way for them to do that?
So my wealth management firm is Tenhauser Financial. I'm Googleable. If people do actually want to have a one-on-one discussion, you can email or call me, reach out, and we'll work something out. Yeah, that's really the best way to get a hold of me.
Well, great. And again, man, thank you so much for your time. This was significantly more expertise than I normally feature on my podcast.
Well, I'm glad you enjoy it, and look forward to the next one.
All right. And if you guys want to support me, you can find the show on Apple, YouTube, Spotify, anywhere you listen to podcasts. If you want to support us more directly, my sponsor, Axios, will make you not fat. And I've met enough of you to know that his services are sorely needed. So check out the link in the description. You can... I'm quite the salesman, Sean.
Buy it, you fat fucks.
Pretty much. It's like, all right, the first rule of sales, insult your client base. Well, anyway, check out the link in the description. And again, Sean, thank you so much.
Yep. Thanks again. I'll see you.
And everyone at home, keep your head up. Flag can't last forever. Good night.